Hello, this is Mijun from Big Tushinron University. Let's begin today's Big Tushin news for June 27th. Welcome once again to Mijun, where we consistently uphold the fundamentals of investing in United States stocks. Another relaxing Friday has come around. I also start the Friday broadcast with a lighter heart. Usually I feel a bit pressured, thinking that the broadcast shouldn't go on for too long, or that I shouldn't send it out too late. But on Fridays, even if I upload a slightly longer video or post it a bit late, there are quite a few people who watch it over the weekend. So I can do the Friday broadcast with a much lighter heart. That's why I'm sitting in front of the camera today, June 27th, feeling a bit more relaxed. Then, to celebrate Friday, let's start today's United States stock news with a joyful heart. Today's a Friday when I feel a bit more at ease. Also, since the atmosphere in the United States stock market has been so good lately, I'll put off talking about the market for a bit. Today, I prepared a segment to talk about some investment basics. For the past few days, I've been thinking it would be good to share this content with my subscribers in the United States and China as well. This is an article I already shared with my United States and China members on June 24th. If you look at the title of this article, there is a champion in the history of United States stocks who achieved an incredible average annual return of 220% over 5 years, which is really hard to believe. I'd like to take a brief look at the secrets to successful investing that this amazing champion shares. His name is Mark Minervini, and according to this description, he is praised as one of the most successful stock traders in United States history. Now, it would be good to listen closely and hear what kind of strategies such a successful investor used and get some investment tips. Mark Minervini? Strict risk management, consistent high returns, and his own specific entry point analysis, these are what set him apart. He was introduced as one of America's top traders, well known for these techniques. He has provided consulting services to various hedge funds. In 1997, he won the United States Investment Championship with an impressive 155% return. And once again, in 2021, he set an all-time record with a 334.8% return and won the championship once more. Now, this incredibly famous investor recently did an interview with MarketWatch, which I subscribe to. In this interview, he shares insights on risk management, trading principles, and his outlook on the current United States stock market. This is a very valuable opportunity for us. I think it would be good for you to listen to it. I can't read the entire thing for you, but I'd like to go over a few questions and their answers together. MarketWatch asked, "What do you think about the current economy?" Minervini answers like this. Right now, we are in a period of sustained bull markets and optimal economic growth. Recently, the news content king has made a slightly different claim. It's the Goldilocks economy. We're seeing real gross domestic product growth of about 2% to 3%, which is a really good environment for a sustained bull market. And the economy isn't strong enough to cause inflation, nor is it slipping into a recession. So, since it's neither too hot nor too cold, it's actually an ideal condition for stocks to keep rising. That's why I'm evaluating it so positively. Now, if you look here, it seems he mentioned taking a cautious approach to small cap and mid cap stocks. Alright, then let's hear why this investor is giving a negative opinion about small cap and mid cap stocks. Minervi? He says that right now, market participation is weak because fund managers don't want to go too far out on the risk curve. Now, this is it. Right now, there are a lot of people holding cash, and they're hesitant to invest in stocks with even a little risk. That's the assessment being made. So they're flocking to the large, heavily weighted stocks within the index. For example, about 40% of the current S&P 500 market capitalization is concentrated in the top 10 stocks, which is a level we haven't seen in decades. Especially in the case of the Nasdaq Composite Index, the top 5 companies account for more than 40% of the total weight. And this is not a broad-based bull market. What we're saying is that the market breadth is very narrow. We look at the market breadth of the S&P 500 every day. Less than 50% of the stocks are in a strong long-term trend. So right now, a very small number of companies are leading the market's upward trend. That's what this is telling us. So, while indices like the S&P 500 are hitting new highs, the percentage of stocks above their 200-day moving average is still very low. So this is a polarized market, meaning the rich get richer and the poor get poorer. In other words, it's a market where only the leading players in artificial intelligence are running ahead. That's how I want to interpret it. If you're investing in large cap stocks within the index, you can make money. I also want to interpret this as investing in the major stocks leading the artificial intelligence revolution. MarketWatch asks this question. You became an investment champion twice and recorded an average annual return of 220% over 5 years. What was the secret to achieving such incredible results? That's a very exciting question. Then Minervini answered that the real secret is risk management and principles. Principles are the key, and you need to have investment principles. It's about fully committing to your strategy, mastering its details, and understanding both its strengths and limitations through every market cycle. I've seen many traders who made a lot of money, but because they didn't respect risk, they suddenly suffered big losses and had to recover just to break even. I rarely fall into a loss pit, and even if I do, it's only a small loss. The simple rule of compounding is that if you don't lose big, it becomes much easier to win. Here's something very important. The reason we invest in stocks is because of the rule of compounding. People even call the rule of compounding magic. That's how well we all know about the rule of compounding. But here's the problem. For the rule of compounding to really work, you have to keep investing successfully for a very long time. If we can keep getting the benefits of compounding for 5, 10, 15, or even 20 years, then even a small investment can eventually grow into something huge. But the mistake we often make is that while following the rule of compounding, if we suffer a huge loss at some point, the rule of compounding gets broken. So the most important thing is that you shouldn't take a loss, and that's what I want to emphasize. That's what we call risk management in professional terms. I also felt this part very deeply in 2022. At that time, I was mainly investing in growth stocks, but I didn't cut my losses. And there was one thing I was relying on. Even if you lose a lot when it drops, the most you can lose is 100%, but when it goes up, it can double, triple, or even go up tenfold. So I thought that if I just invested and held on, the gains would eventually outweigh the losses. I was sticking to this one principle. It was a huge mistake. Now, if I had just left the stocks that were going up alone and cut the ones that were dropping along the way, if I had trimmed them in the middle, my returns would have been much better than they are now. Now I tell you, this is called momentum investing. You have to cut the stocks that are falling before they drop even further. Minervini is talking about this right now. At least that's how I personally see it. So, he said that you need to manage risk. I asked him what specific methods he recommends to manage risk effectively. That's a very effective question. Now, here's what Minervini said. Other than selling your position at a small loss before the loss gets bigger after entering a trade, there really is no other alternative to managing risk. The key is to get out with a single-digit loss, and to do that, you absolutely have to use a stop loss. That's what he's telling us. So, then, is risk management and sticking to your principles really the secret to investment success? That's what he's asking again right now. Well, he says he'd like to tell us something new, but in reality, the situation hasn't changed much when it comes to risk and reward and the law of supply and demand. It might sound repetitive and boring, but if you're looking for a 3 that makes the hair on the back of your neck stand up, you're not managing risk, you're gambling. That's the advice he's giving. So right now he's basically recommending fundamentally sound investing principles. First of all, he said that large cap stocks are better than small or mid cap stocks. Risk management is the most important thing. So, when you buy a stock and it drops, you need to cut your losses to prevent it from falling even further. And you make profits from the stocks that go up. That's what he's saying. Now, many investors are having a hard time making steady profits. He's asking a crucial question. What are they missing? Now, Minervini says, after buying a stock, sometimes it drops by 3%, 4%, 5%, or even 8%. If you buy a stock and the price goes down, you are wrong. If you sell it and take the loss, you are admitting defeat. But the problem is, admitting defeat is never easy. It's not easy, but it's something you have to do. And also, the real fear that keeps people from selling is the possibility that if you sell, it might turn around and go back up. then you end up being wrong a second time. Because if you made a bet and it went down, that was your first mistake. But here, instead of admitting defeat and selling, you just endure it. If you just keep holding on and it drops again, then you end up losing a second time. Now, when you end up being wrong twice like this, psychologically, a very strong force is formed, and even in situations where it's clear that you should sell, you end up holding on to that position. So, to sum it up, we choose various stocks to invest in, and among them, some go up and some go down. What I'm saying is you should cut the ones that are falling before they drop by 10%. Because if you keep holding on to them, they'll keep dropping. Then you end up making mistakes twice in a row. And if you fail twice in a row, in the end, you won't be able to sell next time. That's the advice being given. Next, they asked, what advice would you give to investors right now? Minervini says you need to be careful of information overload, including the thousands of self-proclaimed financial experts on YouTube. He's saying to watch out for Migion. And that's true. A few days ago, I said that the Migion YouTube channel would change, and I needed to share that video with you. That's what I talked about in that video. These days, there's an overflow of information, not just about domestic stocks, but also about United States stocks. The days when you couldn't invest because of a lack of information are over. So now, it's actually more important to reduce the noise, to cut down on the market noise. And you need to find a way to commit to a specific strategy. Instead of being a jack of all trades, you need to become an expert in just one investment strategy. You need to have your own strategy. And if you keep sticking to those principles, you can succeed. That's what they're saying right now. On the Migion channel, we believe that this investment strategy is the momentum investment strategy. And I asked if he made a lot of mistakes when he first started trading. He confesses, I made every mistake you can make. Everything I did back then was the exact opposite of what I do now. I lost money for almost 6 years, and then I turned all my standards upside down. I studied what successful stocks looked like and created a leadership profile, which is what I use now. You look at past history and apply it to the present. If you study which stocks went up a lot in the past, you can find stocks that are likely to have good price increases in the current situation. That's what I'm saying. I asked, you sound like a trend follower. The most important thing is that the stock must be in an upward trend. That's where the famous momentum comes from. I will not trade against the trend. I don't trade or buy stocks with declining momentum. That's what I'm saying. Then I look for stocks that show relative strength compared to the overall market. What this means is if the market has gone up by 10%, I bet on stocks that have risen more than 10%. Rather, you look for stocks with a high relative strength index. That's how you can see it. If a stock doesn't meet my criteria, I stay away from it. I don't touch stocks that have lost their momentum. That's what I'm admitting. This is my final advice. If you're just starting out in investing or trading, don't believe people who say it was easier in the past because trading is so easy now. Right now is one of the best times in history to trade and invest in stocks. That's what I'm saying. You can't become a doctor or a Major League Baseball player in just 6 months or a year. Don't expect that to happen in trading or stock investing either. It will take some time, but it's worth it. So to be good at stock investing, you need that much experience. You shouldn't just say, why aren't my returns going up much after investing in stocks for just 6 months or a year? You need to make a lot of mistakes, look back when you make mistakes, review what you've done, and check which stocks have gone up. And then, when the next opportunity comes, you just have to do better. That's what I've been saying the most recently. You can do better next time. So, if you keep improving your skills steadily while looking at the long term like this, in the end, I want to conclude by saying that everyone who joins this broadcast can achieve an annual return that's more than twice the market average, create wealth, and ultimately achieve financial freedom. So just before this, we heard advice from the best investor who achieved an unbelievable average annual return of 220% over 5 years. I believe that all of you have probably found this very helpful as well. Even if we don't achieve 220%, but just 22% over the next 10 or 20 years, we can still build tremendous wealth. That's how you should look at it. Now, from this point on, I will summarize yesterday's United States stock market trends for you. Yesterday, the market was also covered in a pleasant green, so the breadth of the market widened significantly, and you could see clear green popping up here and there. Overall, you can see that the Goldilocks scenario continued, and the upward trend was maintained. Let's take a look at the breadth of the market. Now, as mentioned earlier, the long-term trend is just so-so. The percentage of stocks trading above their 200-day moving average is 49.9%. So, because of this, people say you should invest in large cap stocks and that the market is currently being led by a handful of artificial intelligence beneficiaries. That was the advice, right? However, if you look at the short-term trend, it's 68.19%. Therefore, nearly 70% of the S&P 500's blue chip stocks are showing a very strong short-term trend right now. So, we can conclude that the upward trend is very strong. Meanwhile, the VIX index has dropped significantly. It's at 16.29. This means that it's a much lower figure than the historical average. So the market is currently very stable and in a unique state. If this drops too much, it means the upward trend is too pronounced. So that could actually be the peak. Because a technical correction could occur, it's a bit too low right now. So we're entering a stage where some suspicion is warranted. Next is the Fear and Greed Index. Recently, it's been staying at a similar level. It's not moving from 60, 61, 62, like I mentioned earlier. It's a Goldilocks situation. It's staying at a very desirable level. Not too hot, but not getting cold either. That's how you should see it. It's the same with the market score. Recently, it did go up to the greed stage, but it doesn't stray far from there. So, as this similar level is maintained over the long term, my personal judgment is that it's still a bit early to suspect that things are excessively hot or that we're in a bubble. Especially if you look at the American Association of Individual Investors survey results announced yesterday, you can see why the market isn't excessively hot yet. The results of the survey conducted on June 25th were released yesterday. Currently, only 35.1% of investors have a positive outlook. They believe that the stock price will be higher in 6 months than it is now, but as many as 40.3% still think the stock price will be lower in 6 months than it is now. They have a negative outlook. Now, why is this important? Looking at the historical average, about 37.5% of people usually have a positive outlook on the United States stock market, and only 31% have a negative outlook, according to historical statistics. But now, there are more investors with a negative outlook than the historical average. What that means is that there are a lot of people who have sold their stocks and are holding cash right now. Why is it important that so many people have sold their stocks? If that's the case, even if stock prices fall, there's not much room for them to drop further. There need to be a lot of people holding stocks for there to be a lot of sellers. But if there are many people holding cash like this, the possibility of an additional crash when stock prices fall is very low. That's one way to interpret it. Now, of course, this positive trend could be broken. That's what happens when a catalyst appears. And today, a very big catalyst is prepared. By the time this broadcast airs, it may have already been announced. At 8:30 anti-meridium, the Core Personal Consumption Expenditures or Personal Consumption Expenditures Price Index Report for May will be released. As you all know well, the Core Personal Consumption Expenditures is the inflation indicator that the Federal Reserve considers most important and prefers. And a year ago, this indicator was very low, which means it's a bit of a disadvantageous situation. Because compared to a year ago, there's a possibility that a slightly higher figure could be announced. That's why if today's figure comes out too high, there's a possibility that the stock market could be a bit shaken. But if the PC price index comes in low again, then there's a high possibility that the market will cheer and the positive trend will actually get stronger. I'll wrap it up here. Before we read the next article, let's briefly check the performance of Mizon's top pick from yesterday. Recently, since artificial intelligence beneficiary stocks have been doing so well, most of Mizon's top picks were also in the positive yesterday. Still, technology has been really strong these days. It went up an additional 3.09%, so the monthly return is now an impressive 53.85%. Second, Meta went up by 2.46%. Following that, Uber was up by 2.44%, Amazon up by 2.42%, Vistra up by 2.19%, Broadcom up by 2.09%, Nextracker up by 1.77%, Google up by 1.68%, Talon Energy up by 1.17%, Palantir up by 0.94%, Celestica up by 0.74%, Taiwan Semiconductor Manufacturing Company up by 0.57%, Nvidia up by 0.46%, Advanced Micro Devices up by 0.20%, and Bitcoin saw a slight increase of 0.1%. The four stocks below fell. B2 was down by 0.37%, Tesla dropped by 0.54%, and MicroStrategy slightly declined by 0.57%. Now, if you look at the very last one, the trade desk dropped by 2.5%, which is quite a significant decline considering yesterday's market atmosphere. I'd like to talk about this for a moment. There's a key reason why the trade desk's momentum has weakened, so let's briefly look at the main point. Wells Fargo downgraded the trade desk's investment rating from overweight to equal weight. And the reason? It's due to concerns about intensified competition with Amazon's demand-side platform. Now, let me briefly explain what this means through a word from Mijun. The trade desk, when it comes to connected television. Connected television stands for connected television. Connected television basically means smart television, so you can think of it that way. It's a television connected to the internet. In the world of smart television advertising, the trade desk is like a department store or a select shop. So what this means is that it's not tied to any specific brand. It brings together and sells advertising space from a variety of channels, regardless of whether it's Samsung Television, LG Television, or YouTube. That's how you should see it. Now, this is the biggest advantage of the trade desk. On the other hand, Amazon is like its own brand store inside a department store. They mainly sell advertising space on their own channels, like Amazon Prime Video. So, if I'm an advertiser, I would only contact Amazon when I want to advertise on Amazon Prime Video. That's what I'm saying. But recently, this week actually, Amazon signed advertising inventory supply agreements with major streaming services like Roku and Disney+. Advertising inventory refers to the spots where ads can be placed. So, Amazon Demand-Side Platform, Demand-Side Platform stands for Demand-Side Platform, is basically a platform where advertisers go to buy ad spots. Now, Amazon's Demand-Side Platform can place ads inside programs like Roku and Disney. That's a huge change. So, from the advertiser's perspective, using Amazon Demand-Side Platform opens up the possibility to run ads not only within Amazon, but also on external platforms like Roku and Disney all at once. So, Wespago, by around 2026, advertisers using the trade desk are likely to try out Amazon Demand-Side Platform. That's the assessment. So, up until now, the trade desk has been the best partner for advertising on various television streaming services, so that's why advertisers have used the trade desk a lot. Now, a huge company like Amazon is directly entering that field, threatening the trade desk's biggest advantage. Because of that, Wells Fargo is now predicting that the trade desk's performance could worsen in the future. So recently it even dropped to a strong sell. After this article came out recently, the stock price didn't do well for about 2 or 3 days, and it was also at a very important inflection point on the stock chart. Now, if you look here, it turned at a very important point. It was at $80, but it couldn't break past $80 and started trending downward again. And it fell below the orange line, which is the 20-day moving average. The green line below is the 60-day moving average, and if it had broken through the 60-day moving average, there was a high possibility that it would have shifted into a downward trend. That's how it could have been analyzed. But fortunately, it didn't break through the 60-day moving average. It's showing signs of rebounding again. In my case, if Trade Desk had fallen below the 60-day moving average, I was planning to remove it from the Miju on top pick list. So I can tell you that the 3.29% rise in the futures market right now is very good news. The next article I prepared is about Meta. These days it's hard not to talk about Meta frequently. They're showing some incredible moves right now. Yesterday, there was a very important news report about Meta's future, so even though I feel a bit comfortable talking about it, I'll go ahead and read you the news related to Meta. Meta Platforms is in the final stages of negotiations to acquire Play Artificial Intelligence, a small startup that uses artificial intelligence to replicate voices. This kind of news has been reported. This is part of the social media company's efforts to secure top talent and not fall behind in the artificial intelligence competition. Recently, they've been showing tremendous effort, at least from a shareholder's perspective. It's impressive to see a chief executive officer working this hard. I want to give a lot of praise. Meta is expected to acquire this startup's technology and some of its employees, which is based in Palo Alto, California. Meta's chief executive officer Mark Zuckerberg appears. They are competing to build artificial intelligence capabilities with rivals like Alphabet's Google and Open Artificial Intelligence. That's why this year, artificial intelligence is the company's top priority. Earlier this month, Meta invested $14.3 billion in Scale Artificial Intelligence, a data labeling startup. And what about Zuckerberg? Recently, he recruited the chief executive officer of this company, who has been building a superintelligence team. As you know well, he recruited Alex Wang. Now, Zuckerberg is also continuously recruiting artificial intelligence researchers from Google, Sesame Artificial Intelligence, Open Artificial Intelligence, and others for Meta's new superintelligence team. He's stealing all the talent. Meta recently hired 3 researchers from OpenAI's Zurich office, the company behind ChatGPT. I shared this news with you a few days ago too. Through the acquisition of Play Artificial Intelligence, Meta can further secure expertise to introduce more voice features into hands-free devices like artificial intelligence assistants and smart glasses, which are Mark Zuckerberg's core focus areas. This acquisition is being introduced as a very significant one. So what is Play Artificial Intelligence, the company being acquired this time? It is introduced on the blog as a company developing artificial intelligence-based voice features that aim to respond like a conversation between 2 people. So, what this means is, when you talk to artificial intelligence, there are some frustrating parts, right? When you ask a question, there's a bit of a pause. You have to wait. But what Play Artificial Intelligence is aiming for is that when you ask a question, you get an immediate answer just like you would from a person. So, you can think of it as a company that builds technology enabling conversations so natural that you can't tell whether you're talking to a human or artificial intelligence. This time, in Jihunmi's words, I'm going to share my very personal opinion, and even if it doesn't match yours, I hope you'll just think, oh, that's another way to look at it, and understand it at that level. Personally, I think this news is about voice-centered interfaces becoming the next generation of smart device user experience. User experience stands for user experience, which is what we call consumer experience. I believe there's great significance in the fact that this is emerging as a key point right now. Let's listen to what this is all about. I believe that the reason writing first appeared in human history is because spoken words are fleeting. So, there was a human desire to leave records, and also a necessity to keep records. That's why writing was invented, in my opinion. But recently, with the advent of cloud technology and smart devices, all voice communication can now be recorded. Even if we don't write it down, everything is still being recorded. Therefore, from now on, I believe that it's almost certain most of the tools humanity uses in the future will be developed mainly for voice, not text. Therefore, I believe that while the past internet revolution and the mobile revolution were based on text, the upcoming artificial intelligence revolution is highly likely to evolve based on voice. Of course, for now, many people are still communicating with artificial intelligence using computers and smartphones. I'm the same way. However, in the near future, it's clear that smart glasses, smart cars, and smart home appliances will take up a large part of our daily lives. And all these smart devices either have limited screens or require hands-free operation. For example, devices inside cars need to allow conversation while driving, and smart glasses are something we'll wear all day, so we need to interact with them by voice. The same goes for smart home appliances. You can have a conversation even while cooking. That's why hands-free operation is so important. So you can think of voice as basically the default user interface. User interface refers to how users connect, how they interact with smart devices. For example, in the United States, 1 out of every 3 adults already owns a voice speaker, what we call a smart speaker. Here in 2021, it was 24%, but as of last year, 2024, it jumped up to 35%. You can see that voice interfaces are becoming a part of everyday life like this. That's the current trend. Now, as for Meta, they own all their platforms: Facebook, Instagram, WhatsApp, Messenger, and Threads. They also have all kinds of hardware devices like Quest and Ray-Ban smart glasses. They are continuously developing Meta artificial intelligence to be integrated into all of these. Now, what about this Meta artificial intelligence? To be competitive, it needs to go beyond simply carrying out commands. The ability to have natural conversations with humans is absolutely essential. And this acquisition of Play Artificial Intelligence is a strategic investment to dramatically improve our conversational artificial intelligence capabilities. That's what I think. Meta directly makes hardware like Ray-Ban smart glasses and the Quest virtual reality headset, and eventually, they are striving to create true augmented reality glasses that are as light and comfortable as regular glasses, but can project high-quality 3D graphics onto the real world. Now, these glasses? The project was originally called Nazare, but recently the name changed. It was changed to Orion, and then it changed once again. It's now called Artemis. Anyway, Meta is currently putting in tremendous effort to create the next generation of smart glasses. But without powerful software, hardware is just an empty shell. But if an advanced voice artificial intelligence is installed in smart glasses and augmented reality glasses, users will be able to conveniently use real-time translation, navigation, and information search just by talking to their glasses. I think this is the key point. Let me give you an example. It's not just asking, can you recommend a restaurant nearby? But rather, what do people think about this restaurant? Is there a good menu item that we could enjoy if we go there with our kids? So, you can think of it like this. Having very detailed, conversational interactions like you're talking to a real person will become possible with artificial intelligence. Therefore, Play Artificial Intelligence's conversational artificial intelligence technology is not just about improving the functions of existing products. It increases the chances of success for Meta's future-defining Project Artemis. And Meta is now putting together one of the most important pieces of the puzzle to take the lead in the next generation of computing with voice capabilities. I want to emphasize just how significant this is. The last content I'll share with you today is today's United States stock video. Recently, because of the Mijun podcast, I haven't been able to send you the daily United States stock videos every day. This series is also a very valuable investment resource because you can directly watch interviews with market experts. Today's video features Rick Reeder from BlackRock. He is a very influential expert who serves as the head of bonds at BlackRock. It would be good to listen carefully to what kind of outlook he has for the future of the United States stock market in the current situation. That's all for today's broadcast. I sincerely thank everyone who joined us this week with Mijung. Mijung's broadcast is also prepared for this weekend. Yesterday, I recorded an episode of United States Stock Elementary School with Chief Executive Officer Kim In-jung from Choice Star. This weekend, we also have a very good lecture prepared for our elementary school students that will be very helpful and valuable for them. Since it's a free lecture, I recommend you don't pay for expensive ones and instead join Chief Executive Officer Kim In-jung's excellent United States stock lecture. And in addition, there's a 50% discount event for Choice TAQ and a 50% discount for the Mijun membership. There are only a few days left now. If you are planning to take advantage of this, I hope you make sure to use this opportunity. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day. Thank you.
Is the market now signaling that there are no issues with the economy and policy path, or is it time to be cautious about risks again? We're joined by Rick Reeder, Global Bond Chief Investment Officer and Head of Asset Allocation at BlackRock. Hello, how are you interpreting the current market trends? With the so-called soft landing risk somewhat resolved, investors are growing and grateful. It feels like a typical market that's somewhat buoyed by a sense of relative optimism. To add to that,
until just a short while ago, the market was in a kind of stagnation. There were various concerns such as issues, tensions in the Middle East, and inflation outlook. As you mentioned, some of those dark clouds have cleared to some extent. And what's very clear right now is that there's a huge amount of money waiting on the sidelines. If we compare global net assets to the size of the fixed income asset, bond, and stock markets, we can see that for quite a long time there's been a huge amount of money waiting on the sidelines. We can clearly see a trend where the money that couldn't enter before is now trying to come in. Unless there are any special negative factors, we can say that the gravitational force of money naturally flowing into assets across the board is at work. And if you look at the economic growth data, it's not bad either. In my opinion, the pace of growth may slow down somewhat over the next few months, but it won't be disappointing or shocking. I think the possibility of a recession has virtually disappeared. From the inflation perspective, the 3-month moving average of core consumer price index is at an annual rate of 1.7%. Is that acceptable? So can the Fed go ahead with a rate cut? I think there's a possibility. I'm not sure if they'll move in July, but I think that opportunity is open. In the meantime,
you've emphasized that the United States economy has a strong structure that doesn't weaken easily. Because service-oriented companies also have excellent profitability, the economy will remain stable as long as there are no major shocks. Tariff threats also didn't actually cause any real damage, and it seems we've escaped that risk for the time being. However, the market is cautiously reflecting on whether tariffs will restrict growth, stimulate inflation in the short term, or have other ripple effects.
One thing I want to emphasize is that this is a phenomenon that repeats every year. When the first or second quarter comes around, people are often gripped by fears of a recession or a severe downturn. But I believe that in a service-based economy like the United States, such things don't happen easily. Another important point is that after the pandemic, there was a massive transfer of funds from the public sector to the private sector, and as a result, the biggest risk now is that the government is carrying the debt. On the other hand, private sector companies, households, and financial institutions have reduced their debt, so their foundations have become much stronger. In fact, it's not the entire economy that's over-leveraged, but only the government is carrying the leverage. Moreover, at that time, central banks kept interest rates at 0%, or even negative in Europe, which provided a foundation for corporate assets and cash flows to grow explosively. Corporate debt was also converted to long-term, making the structure much more stable. So I think the fundamentals of the economy are quite strong right now. Then what factors could hold us back in the current situation? I still think the tail risk is government debt. Government bonds will continue to be issued next year, and that could become a burden. In this situation, I still prefer short and medium-term government bonds. I don't think there's any need to hold a lot of long-term bonds. You can make good returns in the front and the belly, and in the meantime, the stock market will go its own way.
If the economy has resilience and momentum, can we really say that the current 4.2 to 4.5% interest rate is a truly tight stance by the Fed?
For years, the market has worried that if the 10-year yield rises to 3.5%, 4%, or even 4.5%, the economy would collapse. But the reality is different. The current United States economy is not very sensitive to interest rates. Most of the large companies leading artificial intelligence facility investment and R&D are funding themselves through cash flow rather than borrowing. Banks have well-matched assets and liabilities, so they are not greatly affected by interest rate changes, and most consumers have already finished deleveraging. Even though the Fed raised interest rates by 5 percentage points, the economy was not significantly shaken in reality. However, the only reason I believe there is a possibility of a Fed rate cut is the housing market. Mortgage rates are too high, and as a result, housing supply is blocked. Home builders have to subsidize mortgages, which reduces their margins, and eventually they stop building houses. But housing cost inflation is actually the core of the most persistent inflation. So I think if we lower interest rates, this part can be alleviated. As Chairman Powell said, tariffs will have some impact on inflation over the next few months, but ultimately, the most substantial and effective place where interest rates have an impact is the housing market. I believe it should especially be in a direction that helps the younger generation enter the housing market.
The start of a small dream is important. Let's plant a hopeful future together. Growing little by little every day. Is there excitement in your heart? Let go of your greed. It won't be any different this time. The result is just a continuation of the process. Even if a dark adjustment comes, I'm not afraid. Holding Miju's hand, I'll move forward and become the light of an unseen tomorrow. Happy investing, cheering on each other's dreams. Let's walk together down this beautiful downhill path. Happy investing together with Miju until the day we all boldly retire at the national market price, all together. Thank you.